Hello, and welcome back to the channel. I'm Algabot, and today we're taking an educational look at an expert advisor for MetaTrader 5 called the Trimmed Mean Reversion Band. This is a mean reversion strategy built around a very robust idea of fair value, using something called a trimmed mean instead of an ordinary moving average. Over the next few minutes, we'll explore what the trimmed mean is, how the strategy defines its bands, how it decides when a market is calm enough to fade a stretch, and exactly how the entries, stops, and targets are managed. Everything here is educational only, so let's dig in. So what does this expert advisor actually do? At its heart, the Trimmed Mean Reversion Band is a counter-stretch mean reversion strategy. It was built and tuned with the euro against the US dollar in mind, but the logic applies to any liquid foreign exchange major or metal, and it runs on a single primary time frame, whatever time frame you choose to test it on. The distinctive idea here is the trimmed mean. Most reversion bands, like Bollinger Bands or envelopes, anchor on a simple or exponential moving average. The trouble is that a single spike bar or a sharp news candle can drag that average around, which smears the estimate of fair value and also inflates the band, so genuine stretches stop looking extreme. This strategy takes a different approach. Over a look-back window of closing prices, it sorts them, discards a fixed percentage from both the top and the bottom, and then averages only the central core. That central average is the trimmed mean, a classic outlier robust measure of location. The bandwidth then uses the standard deviation of that same trimmed core, so both the center and the spread ignore the fat tails that dominate currency markets. On top of that, the strategy adds a regime filter. It only looks to fade a move when the market is genuinely ranging, meaning the trimmed center is roughly flat over a short look back. Strong trends are skipped entirely, so the strategy tries to avoid the classic mean reversion mistake of fighting a runaway move. Who is this style suited for in an educational sense? It's aimed at traders who are curious about robust statistics, range-based reversion, and disciplined, structural risk control rather than trend chasing. As always, remember that trading carries real risk and losses do happen. Nothing here is a recommendation or a promise of any outcome. It's simply a walkthrough of how the code is designed to behave. Let's walk through the mechanics step by step. On each newly closed bar, the strategy first gathers the last several closing prices, the number set by the lookback parameter, which defaults to 40. It sorts those closes, trims away the top and bottom 15% by default using the TrimPercent parameter, and averages what remains. That gives the trimmed mean, our robust center or fair value. It then measures the standard deviation of that same trimmed core to get the spread. From there, the strategy builds two bands. The lower band sits at the center minus EntryZ times the spread, and the upper band sits at the center plus EntryZ times the spread. EntryZ defaults to 2, so the bands are roughly 2 trimmed standard deviations away from fair value. Before considering any entry, the strategy checks the regime. It compares the current trimmed mean to the trimmed mean a few bars ago, set by slope lookback. If that difference is larger than FlatSlopeAtr times the current ATR value, the market is judged to be trending, and the strategy simply stands aside. It only proceeds when the center is roughly flat, meaning conditions are ranging. Now the entries. For a long, the strategy detects that the just closed bar dipped its low below the lower band, a statistical stretch to the downside, but then reclaimed that band, closing back above it, and closed bullish with the close above the open. That reclaim is read as the downside extreme being rejected. The short side is a mirror image. The bar pokes its high above the upper band, then closes back below it, and closes bearish. That's an upside stretch that was rejected. Risk management is built for a small footprint. The stop is placed just beyond the rejection bar's extreme, padded by stop buffer ATR times ATR. So if the reclaim proves false, the position exits quickly for a modest loss. The target is the trimmed mean itself, the natural reversion objective, and the trade is only taken if the reward to risk clears the min target R minimum. Finally, once price travels halfway to target, the stop is pulled to break even, so a winning move is protected from turning into a loss. Only one position per symbol is held at a time, and entries are evaluated once per closed bar. Let's read through the meta-editor code on screen. At the top are the key inputs. Lookback is the window of closes for the trimmed mean, 40 by default. TrimPercent is the fraction cut from each tail, 15%. EntryZ sets the band half width in trimmed standard deviations, 2 by default. Lookback and FlatSlopeAtr control the flat center regime gate. StopBufferAtr pads the stop, and MinTargetAtr sets the minimum reward to risk needed to take a trade. Now the long block. The condition checks 3 things at once. The signal bar's low dipped below the lower band. Its close came back above the lower band, and the close was above the open, a bullish reclaim. When all 3 are true, the entry is taken at the ask. The stop loss is set just below the bar's low, padded by the ATR buffer, and the take profit is set to the trimmed mean, our fair value. The trade is only sent through trade.buy if the reward covers the minimum reward to risk multiple. The short block is the mirror image. The signal bar's high pushed above the upper band. The close came back below it, and the close was below the open, a bearish reclaim. The entry is taken at the bid. The stop sits just above the bar's high plus the ATR buffer, and the take profit again targets the trimmed mean. It goes to trade.sell only when the reward to risk minimum is satisfied. Both sides share the same clean, symmetric logic. Let's walk through this illustration candle by candle. On screen, you can see 3 dashed reference lines drawn over the price. In the middle, in gold, is the trimmed mean at 1.0850, our robust fair value. Above it, in blue, is the upper band at 1.0872, and below it is the lower band at 1.0828. Notice how flat these lines are. That flatness is exactly what the regime gate is checking for. Because the trimmed center is roughly level, the market is judged to be ranging, and the strategy is willing to fade stretches. Look at the first couple of candles. Price is drifting quietly just around the trimmed mean, moving gently between the bands. Nothing is stretched yet, so the strategy waits. On the third candle, price starts easing lower, edging down toward the lower band. This is the approach phase, where a potential setup begins to build. Now watch the fourth candle in the sequence, the one marked with the buy entry. Its low pierces below the lower band, a genuine statistical stretch to the downside. But instead of collapsing, price snaps back. The bar closes back above the lower band, and it closes bullish, with the close above the open. That reclaim is the heart of the long signal. The downside extreme was poked and then rejected. At that point, the buy entry marker appears. The stop is placed just below that rejection low, padded by the ATR buffer. So if price had simply carried on falling, the loss would be small and structural. The take profit is set to the trimmed mean itself. From there, price lifts off the lower band and climbs back toward fair value. On the very next candle, price reaches the gold trimmed mean line at 1.0850, and the take profit marker prints. The reversion played out exactly as intended, from a rejected stretch back to fair value. And remember, once price had covered half the distance to target, the stop would have been pulled to break even, protecting the position along the way. Now the market drifts higher over the next few candles, still hugging fair value, still calm enough for the gate to stay open. Watch the ninth candle, the one marked with the sell entry. Here the mirror pattern forms. The bar's high pushes above the upper band at 1.0872, an upside stretch. Then price falls back, closing below the upper band, and it closes bearish, with the close below the open. That is the short signal, an upside extreme that was rejected. The sell entry marker appears. The stop is set just above that rejection high plus the ATR buffer, and the take profit again targets the trimmed mean. Price then rolls over and slides back down toward fair value. On the following candle, it reaches the gold trimmed mean line once more, and the take profit marker prints for the short. Both trades share the same clean idea. Wait for a calm, ranging market, let price stretch beyond a robust band, require a reclaim that shows the extreme was rejected, then aim for a return to fair value with a tight, structural stop guarding the position. That symmetry between the long and the short is the core behavior of the trimmed mean reversion band. And that brings us to the end of our educational walkthrough of the trimmed mean reversion band. We covered why it uses a trimmed mean as a robust measure of fair value, how the bands are built from the trimmed core's standard deviation, how the regime gate keeps it in ranging conditions, and how the reclaim entries, structural stops, fair value targets, and break-even lock all fit together. Remember, everything here is for educational purposes only. It is not financial advice, not a recommendation, and not a solicitation to trade. Trading involves real risk and losses do occur. If you found this breakdown useful, please like the video, subscribe for more MetaTrader 5 strategy analyses, and leave a comment with any strategy you'd like us to explore next. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.